Imagine a company on the brink of collapse suddenly gets a multi-million-dollar lifeline while still in bankruptcy. That's not just rare, it's a financial twist that can save jobs, entire towns, and even whole industries. So, what exactly is a DIP loan, and why do creditors line up to hand cash to a bankrupt business? First, let's ask the big question. How can a bankrupt company borrow money? It sounds crazy, but in the world of Chapter 11 bankruptcy, this is where debtor-in-possession, or DIP financing, steps in. DIP loans let struggling companies keep their doors open, their lights on, and their employees paid, all while they reorganize and try to get back on their feet. Why would any lender risk money on a company that's already defaulted? Here's the twist. DIP lenders get supercharged protection. By law, their loans take priority over almost everyone else's claims on the company's assets. This means if things still go south, DIP lenders are first in line to get paid, ahead of previous creditors and even secured lenders. Does DIP financing actually work? Absolutely, and with dramatic results. During the Great Recession, General Motors and Chrysler both secured DIP loans that allowed them to reorganize and eventually return to profitability. Without these loans, both might have vanished, taking tens of thousands of jobs with them. What makes a business worthy of a DIP loan? Lenders don't just hand out cash to any bankrupt company. They do a deep dive into financials, searching for a clear, realistic plan to recover. If the numbers make sense and the turnaround strategy checks out, the DIP loan is approved. This confidence can ripple out, restoring faith among suppliers, customers, and investors. How is the money used? DIP funds are lifelines, not blank checks. Companies use DIP loans to cover payroll, buy inventory, pay essential suppliers, and keep up with the everyday expenses that can't wait for a bankruptcy court. Think of it as putting gas in the tank to keep the engine running during a storm. Is DIP financing a win for everyone? Often, yes. For the company, it's a shot at survival and a chance to protect jobs. For lenders, it's a calculated risk with priority repayment. For previous creditors, it's better than a fire sale liquidation, which usually means getting pennies on the dollar. Can small businesses get DIP loans, or is it just for corporate giants? While headlines focus on big names, small and mid-sized companies can also secure DIP financing if they have a viable plan and lenders believe in their turnaround story. What happens if the company still can't recover? Even then, DIP financing has a built-in safety net for lenders. Because their claims come first, they have a much higher chance of recouping their money, even if the company's assets are sold off. Does DIP financing help the wider economy? Yes, by preventing sudden shutdowns, DIP loans protect jobs, supply chains, and even local economies. Instead of a ripple of layoffs and unpaid bills, DIP-backed businesses can keep contributing while they regroup. So, when does a DIP loan make sense? When a business is fundamentally sound but temporarily distressed. DIP financing can bridge the gap between crisis and comeback. It's not a magic wand, but it's a powerful tool in the world of corporate recovery. Because understanding DIP loans reveals how lenders weigh risk and reward in even the toughest situations. The next video reveals how warehouse loans work and how they quietly power the entire mortgage industry. If you want to know how banks really fund your home loan, you can't afford to miss what's next.